Section 1 Hook. I want to say something I know is going to make some people uncomfortable. Saving money the way most Americans do it, the way most financial advice tells you to do it, is a losing strategy. Not in every context, not with zero nuance. But as the primary vehicle for building long-term wealth, saving is fundamentally the wrong tool for the job. And the math proves it. Now, before you click away, I want to be precise about something. I am not telling you not to have an emergency fund. I am not saying cash is worthless. I am not arguing that you should spend everything you earn. What I am arguing is that the story most people were told about money work hard, spend less, repeat for 40 years leaves out the most important variable in the entire equation. And that missing variable is the reason millions of financially responsible, hard-working people reach their 50s or 60s with far less wealth than they should have, despite having done everything they were told. The missing variable is this: saving stores money. Investing moves money, and wealth is not built by what you store, it is built by what you move, where you move it, and how quickly it generates more. Today we are going to talk about what actually creates wealth through the lens of cash flow, and what economists call the velocity of money. We are going to look at what saving alone actually costs you over time, why the traditional advice is incomplete at best and misleading at worst, and what the people who are genuinely building wealth are doing instead. Let's start with the most uncomfortable number in personal finance. Section 2, the real cost of saving. What nobody calculates here is the number that changes how you think about saving forever. The national average savings account rate at traditional banks in 2026 is 0.39% AP. Inflation is currently running at approximately 2.7% annually. That means money sitting in a traditional savings account is losing approximately 2.3 percentage points of real purchasing power every single year. Not in theory, not hypothetically. Actually, measurably, losing value in terms of what those dollars can buy. On $10,000 in a traditional savings account, you earn $39 in interest over a year. But the same $10,000, adjusted for 7% inflation, needs to be worth $10,270 at the end of that year just to have maintained the same purchasing power. Your savings account gave you $10,039. You are $231 behind where you started, in real terms. Your money worked against you while you were busy feeling responsible. Now, and this is important, the high-yield savings account changes this picture meaningfully. The best HISA rates in 2026 sit at approximately 4.0 to 4.1% AP. That genuinely outpaces the current 2.7% inflation rate by about 1.4 percentage points. Your purchasing power actually grows. This is why we talk about high-yield savings accounts on this channel, and why keeping your emergency fund in one is the correct move. But here is where the savings strategy fundamentally breaks down, even with a high-yield account. At 4% AP, your money doubles approximately every 18 years. At the historical average S&P 500 return of 10%, money invested in a low-cost index fund doubles approximately every 7.2 years. That difference, 18 years to double versus 7.2 years to double, is not a minor advantage. It is the entire gap between arriving at retirement with enough and arriving with financial stress. It is the difference between the same $50,000 growing to $197,000 over 20 years in a HISA versus growing to $336,000 in an index fund. Same money, same person, same discipline. $336,000 versus $197,000. The tool made the difference, nothing else. But the problem with pure saving goes deeper than the return rate. It goes to the entire mental model. The savings trap, hoarding versus deploying. Most people were taught to think about money as something you accumulate. You earn it, you hold it, you protect it from being spent. The bank account grows. The number gets bigger. You feel more secure. This mental model, money as something you hoard, is the psychological foundation of the traditional saving strategy. The problem is that this model treats money as the destination. It is not. Money is a vehicle. Its power comes entirely from where it goes, not from where it sits. A dollar sitting in a savings account is doing one job: existing. A dollar deployed into an S&P 500 index fund is doing a completely different job: working, compounding, generating returns that generate their own returns, building on itself without any additional action from you. The people building serious wealth are not the ones with the largest savings accounts. They are the ones who understand that every dollar has a velocity, a rate at which it is moving and generating additional economic activity. Money sitting still has near zero velocity. Money invested in productive assets has high velocity. And the compound effect of velocity, sustained over years and decades, is where real wealth comes from. This is not a complicated or abstract concept. The question is not how much am I saving, it is how quickly is my money generating more money. Those are genuinely different questions with genuinely different answers. Section 3. Wealth Velocity. The concept that changes everything. Let me give you the framework that makes all of this concrete. It is called wealth velocity. And once you understand it, you will never think about money the same way. Velocity, in the physical sense, is speed with direction. An object moving fast in a random direction has speed but not useful velocity. An object moving precisely toward its target has high effective velocity. Money works the same way. Wealth velocity is the rate at which each dollar you earn is converted into assets that generate additional income or growth, and how quickly those assets begin working. High wealth velocity means that the gap between when a dollar enters your account and when it starts producing returns is short. Low wealth velocity means money sits idle for extended periods before doing anything productive. The traditional saving strategy has inherently low wealth velocity. Money arrives, gets moved to a savings account, sits there accumulating a modest return, and waits. For months, sometimes years, until you decide what to do with it. Every day that money is sitting rather than deployed is a day it is not compounding at its highest potential rate. High wealth velocity looks different. Money arrives, and the allocation system is already in place. A predefined share goes to the investment account, automatically index funds that are already working by the time the next paycheck comes in. The emergency fund is exactly the right size for its purpose, not a penny larger. Because excess cash in a savings account is negative velocity money. Income-producing assets, investments, a rental property, a business, are generating their own returns continuously, without any new action from the person who deployed them. The 3 stages of wealth velocity. The first stage is earning. This is where most financial conversations start, and, unfortunately, most financial conversations end. Earn more money. Get a raise. Start a side hustle. Earning is the input. It is necessary. But on its own, income does not create wealth, it creates the raw material for wealth. People with high incomes and low wealth velocity have nothing to show for years of high earnings. People with moderate incomes and high wealth velocity build significant net worth over the same period. The second stage is deployment. This is the critical stage that saving-focused financial advice consistently underemphasizes. Deployment means moving money from idle to productive as quickly and systematically as possible. The most powerful deployment mechanism available to ordinary Americans is automation, setting up investment contributions to arrive on payday, before the money ever sits idle long enough to be spent or left uninvested. The highest velocity deployment targets are the ones we have discussed on this channel: employer 401k match, Roth IRA, S&P 500. These are vehicles where money begins compounding the moment it arrives. The third stage is compounding. This is where wealth velocity reveals its full power. Compounding is the process where returns generate their own returns. In year 1, a $10,000 investment at 10% earns $1,000. In year 5, the same original investment has grown to approximately $16,000 and is earning $1,600 in that single year without any new contribution. In year 15, it is worth $42,000 and earning $4,200 per year. The velocity of compounding accelerates over time. The earlier the deployment, the more years of acceleration you capture. Every year of delay is not just 1 year of missed returns, it is 1 year of missed acceleration. And that math is irreversible. Section 4, the cash flow shift. What actually builds wealth? The mental shift at the center of this entire conversation is moving from thinking about money as a stockpile to thinking about money as a system. Wealthy people do not primarily think about how much they have saved. They think about how much their money is producing right now, this month, independently of whether they show up to work tomorrow. This is the cash flow lens. Net worth is a snapshot what you own minus what you owe at a point in time. Cash flow is a movie, the ongoing rate at which money is moving into and through your financial life. Someone with a high net worth but zero income producing assets is one job loss away from drawing down that net worth. Someone with a modest net worth but strong cash flow from investments is building wealth that does not depend on trading time for money. The goal over time, not overnight, is to build a financial system where your deployed assets are generating income that continuously accelerates your wealth velocity. Your S&P 500 index fund growing at 10% per year is producing returns that get reinvested and compound further. A rental property generates monthly rent that covers the mortgage and produces surplus cash flow. A maxed Roth IRA compounds tax-free for decades and generates distributions in retirement that are entirely untaxed. Each of these is a component of a cash flow system, not a pile of saved money, but a set of working, producing, compounding assets. The specific shift from accumulation mode to deployment mode here is what this looks like in practical terms for someone who is currently in accumulation mode, saving diligently, but not deploying effectively. The first move is to size your emergency fund precisely. 3 months of essential expenses for a dual income household. 6 months for a single income household. That is the target, not more. Every dollar above your emergency fund target that is sitting in savings is a dollar with near zero velocity that belongs in the market. The second move is to automate investment contributions on payday. Not monthly. Not when you remember. Automatically, on the day income arrives, before the money touches your checking account in a meaningful way. The deployment happens first. The lifestyle runs on what remains. The third move is to choose vehicles that compound continuously. A low-cost S&P 500 index fund available in every 401k and every brokerage account compounds 365 days a year. Dividends are reinvested. Gains build on gains. You do not have to make any decision after the initial deployment. The asset does the work indefinitely. The fourth move is to resist the psychological pull of cash accumulation. Savings accounts feel safe. A growing savings balance produces a specific kind of emotional comfort that an investment account balance which fluctuates daily does not. That emotional comfort is real and it has value. But it costs something. What it costs is the difference between 4% and 10% compounded over 20 years. The person who can tolerate the fluctuation of an investment account and keep the money there through market dips is the person who captures the full compounding advantage. The person who moves money back to savings every time the market drops is the person who consistently misses the recovery and pays for the emotional comfort with their financial future. Section 5, the bottom line plus. Call to action. Let me close with a complete argument. Clean. Saving money is not a virtue, it is a starting point. The virtue is in what you do with the money after it is saved. And what you do with it determines everything about your long-term financial outcome. Here is the complete framework. Keep your emergency fund 3 to 6 months of essential expenses in a high-yield savings account, fully funded and untouched. Keep a precise short-term savings bucket for any goals with a timeline, under 2 to 3. Everything else, every dollar with a longer time horizon, belongs deployed into low-cost index funds, working and compounding at the highest velocity available to an ordinary investor. The shift is from thinking about wealth as a pile you protect to thinking about wealth as a system you build. The pile strategy produces an account that grows slowly and loses to inflation without a high-yield account. The system strategy produces assets that compound at 10% annually, build on themselves, and eventually generate returns that exceed your ability to spend them, which is the definition of financial freedom. Saving money keeps you safe. Deploying money builds your future. You need both. But only one of them is a strategy for wealth. And if you are spending most of your financial energy on the safe side while the deployment side goes unaddressed, this video is the reason your net worth may not be moving the way you expected. Here is your action from this video. Calculate your emergency fund target, 3 to 6 months of your essential monthly expenses. Compare that number to what you currently have in savings. If your savings exceeds that target by a meaningful amount, that excess is negative velocity money that belongs in the market. Open your brokerage or IRA app this week and start the process of putting it to work. Drop a comment below. Did you grow up in a household that taught saving as the primary financial strategy? I want to know how many people watching this were shaped by that thinking, and how long it took to see the distinction between saving and building wealth. Subscribe for a new personal finance video every week. See you in the next one.